Hello and welcome back to Stocks Telegraph, the channel that brings you the latest news, insights, and analysis from the world of the stock market. In this video, we'll be providing you with a comprehensive overview of different types of stocks, including common versus preferred, and blue chip versus penny stocks. Investing in the stock market can be complex and overwhelming, especially for beginners. That's why it's important to have a clear understanding of the different types of stocks available before you start investing. So, let's dive in. When you invest in stocks, there are two main types of stock you can choose from: common and preferred. Common stock is the most common type of stock and represents ownership in a company. When you purchase common stock, you become a part owner of the company and have a say in how it's run. One of the benefits of owning common stock is that it entitles you to a share of the company's profits. As the company earns money, it may choose to distribute some of those profits to shareholders in the form of dividends. Common stockholders are entitled to receive these dividends, which can be a source of income for investors. Another important benefit of owning common stock is that you have the right to vote on important company decisions. For example, you can vote on who should be elected to the company's board of directors, which can have a significant impact on how the company runs. This gives common stockholders a sense of control and involvement in the companies they invest in. On the other hand, preferred stockholders do not have voting rights. Instead, their main advantage is that they have a higher claim on the company's assets and earnings. In the event of bankruptcy, preferred stockholders are paid before common stockholders. This means that if the company is forced to sell off its assets to pay off its debts, preferred stockholders will be first in line to receive their share of the proceeds. While preferred stockholders do not have voting rights, some preferred stocks may come with additional benefits, such as a fixed dividend payment. This means that preferred stockholders will receive a set amount of money each year, regardless of how well the company performs. This can provide investors with a sense of stability and predictability when it comes to their returns. Overall, the choice between common and preferred stock comes down to your investment goals and priorities. If you're looking for a more active role in the companies you invest in, and are willing to accept the risks that come with voting rights, common stock may be the better option. If you're looking for a higher level of security and priority in the event of bankruptcy, preferred stock may be more appealing. When investing in stocks, it's important to understand the distinction between blue chip and penny stocks. Blue chip stocks are shares of large, well-established companies that have a history of stable earnings, a solid reputation in the market, and pay regular dividends to their shareholders. These companies are typically leaders in their industries and have a market capitalization of billions of dollars. Investing in blue chip stocks is often considered a low-risk investment strategy. These companies have a long history of success and are generally considered to be financially stable. While the returns from investing in blue chip stocks may not be as high as with other types of stocks, they offer investors a degree of safety and reliability. Penny stocks, on the other hand, are shares of small companies with a low market capitalization that trade at a low price per share. These companies may be in the early stages of growth or have an unproven track record in the market. Because of this, investing in penny stocks is considered a high-risk strategy. One of the reasons penny stocks are considered high risk is because they are often volatile. The price of a penny stock can fluctuate dramatically in a short amount of time, and it's not uncommon for these stocks to experience large price swings in a single day. This volatility can be both a blessing and a curse for investors. While penny stocks have the potential to offer high returns, they also come with a higher degree of risk. Investing in penny stocks can be appealing to investors who are willing to take on more risk, in exchange for the potential of higher returns. However, it's important to do your research before investing in any type of stock, including penny stocks. Be sure to understand the company's business model, its financials, and the risks associated with investing in the company. In summary, the distinction between blue chip and penny stocks comes down to risk versus reward. Blue chip stocks offer investors a lower level of risk and lower potential for high returns, while penny stocks come with a higher level of risk and the potential for higher returns. It's important to consider your investment goals and risk tolerance when choosing between these two types of stocks. As always, it's important to do your due diligence before investing in any type of stock. So, which type of stock is right for you? It really depends on your investment goals, risk tolerance, and investment horizon. Blue chip stocks are generally considered to be low-risk investments that provide a steady return over the long term, while penny stocks offer higher potential returns but come with greater risks. Meanwhile, the decision to invest in common or preferred stocks comes down to whether you prioritize ownership or dividends. We hope you found this video helpful in understanding the different types of stocks available for investment. If you have any questions or comments, feel free to share them in the comments section below. And don't forget to visit our website, stockstelegraph.com, for more news, insights, and analysis from the world of the stock market. Thank you for watching, and don't forget to subscribe to Stocks Telegraph for more content like this.